So ever since mid-September, we've been seeing a trend. Companies reporting earnings have been declining in reaction to their news. Not necessarily gapping lower, but just once the market opens, the stock opens for trading, it's just a drift lower. And it's something like 3/4 of stocks have traded down on their results.
That's not a bad earnings season. That's a market that might have been overbought.
Right. So yeah. So the results have been very good. So it just what my point is just that the market, to your point, the market reaction has been weak. We've been seeing selling on the results, and until we see a reversal of that trend, company investors bidding up stocks after they report, it just tells you that sentiment still has to get reset. What's interesting about today is that throughout this entire sell-off since the September highs, the biggest gap down we've seen in the S&P 500 is 40 bips. So we have all the selling that we've been seeing has been intraday when the market's been open, whereas today we're seeing a big flush. And we had that big drop a week and a half ago. Normally you need to see a retest. So it's not fun to see the futures down 300, but normally it's good to see a retest. So what we'll be looking for here is, will we see an expansion in new lows, or will we see a contraction versus what we saw 2 weeks ago?
Which tells you what, either way?
So if we see, first of all, if we don't hold 2,700, well, then that's not a successful test. But if we see more new lows, that just tells you that there's broader weakness. But if you see a contraction in the new lows, that tells you that investors are being more discerning with stocks. But throughout the sell-off, we break up the S&P 500 into deciles based on different trading characteristics, institutional ownership, valuation, short interest, PE ratios, whatever metric you want to look at, whether it's the cheapest valuation or highest valuation, everything's been trading lower. So it just goes to show that it's not just, certain areas have been hit harder like cyclicals, but everything's been going down. And that just tells you more that it's a positioning trade rather than maybe something economically dire.
All right, Hans, you say that there's some angst here about the Fed and other things. So there's a reason for the trepidation, but you don't think the bull is over. But I don't think of you as ever being very bullish in the last year. Were you ever really very bullish in the last year and a half?
Yeah, actually, we were pretty bullish on small cap, and we actually didn't underweight our U.S. equities. So we participated on the upside. But I think to your point, though, we're going through a reset right now. We had a heck of a run in September. There's a reset that's going on as a result of higher interest rates. I think TINA is truly dead now, right? There is an alternative for equity investors. And there's this reality that at best earnings are going to get cut in half next year. They'll probably be down a bit more, the growth rate that will be. So we'll go from somewhere on 20% earnings growth this year to maybe 10% next year. I'm thinking perhaps more like 8% with a strong dollar. Some of those foreign earnings will get translated back at less favorable rates. And the reality is that investors have to sort of reset expectation. The bottom line in all of this is that I think we're moving along the ridge line of this market peak in this cycle, as well as the economic peak.
So what about 2019? When would you say that the bull is long in the tooth, Hans?
Well, I think, when you're at a peak, right, you sort of see everything that you hope to see, right? From my view, I'd expect to see the yield curve start to act problematically the latter part of next year, which would mean that, the economic environment would turn sometime in the latter part of 2020.